Coming to you live from downtown Detroit, this is ZYNGA's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, traders and investors. Welcome to this Wednesday edition of ZYNGA's Pre-Market Prep. Spencer Israel here with Joel Elconin and Dennis Dick. On the show today, earnings will continue to be the main driver of what we talk about. Snapchat, Take-Two, ZYNGA, just to name a few. We'll also talk about the follow-through in Priceline. Mallinckrodt, of course, had a terrible day yesterday. We'll talk about that as well. Guest today, Morad Askar, otherwise known as Futures Trader 71, who'll join the show at 8:35. Joel, how's it going this morning in markets?
Cold. It's a cold morning. Winter has come upon us. It was slow coming, but it's here. I feel like it's coming anyways. At least it's fall. No snow yet. There's no snow, so I guess you can't say it's, yeah. But when it starts getting below 32, you start thinking, winter is coming. So got to get ready. Get your stuff and get your snow blowers out, or we don't really need those in the Motor City that much. Get your snow shovels out and get ready because it's coming. Joel does nothing to say to that.
Well, Joel is actually, I think, on mute on his computer.
No, I'm not. I'm here, and I'm live here at ZYNGA's Pre-Market Prep. I just forgot to unmute myself, Spencer. We should be good to go here.
Okay, hopefully we're good to go here. Joel, a little gremlins here this morning. We haven't had gremlins for a while.
I
know.
That one, so. That was my bad. I know, you guys like to blame me for a lot of things that I don't do, and Spencer told me to unmute, and I didn't. But we're here, and you guys haven't missed anything because we haven't covered any earnings reports yet. So, Dennis,
we haven't covered any stocks even yet. We haven't talked about the markets yet. The big sell-off last night, Joel, the crash from last night. We didn't talk about the crash from last night. Tell us about it.
Well, Dennis, I was asking you about it, and did you actually buy like spiders and not hedge?
I did. Oh. I actually went naked long. Usually when I'm buying spiders, I'm going to hedge or I'm going to do something. I always like to trade market neutral. But last night, SP futures down 7 points, and SPY was trading down 70 cents. I'm like, you know what? Just buying some naked long. Because why? Because it just works. And I come in here this morning and the market's almost flat, so I turned around and sold my naked long position. It's ridiculous. I mean, in the S&Ps, it pulls back 6-7 points you buy. I don't know if I should start doing that. It's a little bit, aggressive to just say, okay, I'm going to buy every 5, 6, 7 point pullback, but it's what's worked for everyone.
But before you did that, you made an interesting comment on the pre-market show, and you said, you looked around, you looked for news, you just didn't automatically do it. You tried to see if there was a catalyst, right? And
yeah, I automatically thought the catalyst maybe North Korea said something, is what I'm thinking right away. Whenever I see a 7 or a 10 point sell off, and it's not, from a stock, and there was no major companies that reported last night that were going to drive the S&P futures down 7 points. I think North Korea. I mean, I looked and I scoured and I was like, I don't see anything coming from over there either. I know Trump, canceled some meeting or something, but really, I didn't see the catalyst. If anybody else knows what the catalyst was for the 7 point sell off last night, please let me know because I have no idea.
All right, so let's move on. What do we want to start with? Earnings disasters or earnings beats?
Well, just recap the one disaster from yesterday, and that was Priceline. And we talked about it on the show, and this is why you don't want to be the first guy coming in and saying, okay, it's down 200 points or it's down 150 points. How low can it go? I'm just going to buy it. You know why? Because once the ball starts going in one direction in this market, and we've said this, multiple times on the show, once the ball gets going in one direction, it's hard to get the ball going the other direction. And the momentum starts coming in, and the stocks just continue to move in that direction. And Priceline opens down 150 points and loses another 100 points. Incredible move yesterday, losing over $250 PCLN. Joel, what are you thinking?
Well, this is one of the times, and you and I talked about it in this great bull market, shorting in the hole. How many times maybe for the overall market, something opens up that much lower. And I think what exacerbated this move is, the buy the dippers came in on that open, had a 1246.70 open, or not 12, 17. You only had a $1.30 pop. So if you bought that open, you did not have much time at all. And then in a non-liquid stock like that, just
$1.30 was probably the spread.
Yeah. Exactly.
At that time.
Exactly.
Or maybe even with more than that. So you basically, if you bought the open, you were underwater. There was no getting out and saying, okay, I'm not going to lose money on this because it just collapsed.
All right. And for you Priceline traders here, we're trading down 372 in the pre-market. Let's just keep an eye on yesterday's low, 1638.10, and then also the close. Those are a couple good numbers off an earnings report. Now, well, I don't know what you want to do to put in a double bottom here. I mean, it could theoretically go to 1635 and, still really, you could still call the double bottom. Let's look at the monthly here. And boy, oh boy, under 1600, let me see if I can give you a number here. Under 1600, 1562.85 if you take out that psychological $1,600 level.
Yeah, and I would just keep exactly what Joel said. Yesterday's low is, you want these setups, you want the stock to stay, at least close. Like if it trades down, you got to give it a little bit of. And trades down 1635, I don't consider that really a breach of yesterday's low by $3 on the $1,600 stock. But we start going down through 1630, then you're in a breach situation, and who knows how far this can continue to fall. You know how I like my 2-day move. The momentum is down on this thing now. I don't think there's a lot of people stepping in to buy the open this time because they all got killed yesterday if they were buying the open in the 1700 handle. So wait for the thing. And that's the whole thing I think on these earnings plays. If you're looking at these and licking your chops as this is a good price, juicy investment there, it seems to pay to wait. And, I used Celgene yesterday as the example when I was saying, you should wait on Priceline at the 1700 area because Celgene went down, and then had the bad earnings report and went down again. Well, it gave you 2-3 chances actually in the 95 handle the next day. So we got down to 94.55 on the first day. Then we got down to 95.52. Then we're in the 98s. And then we even leaked back down to the 97 a couple of times. I mean, it gives you a shot in the area before it starts to look interesting. Now Celgene actually does look interesting. It is bumping its head up against the wall there at 102.50. Again. A new high on the move, 103.02. I mean, you're getting into an area, and there is some people that are probably licking their chops on this one here too. It gets interesting here now. Celgene looks like it could be ready to break out here. Full disclosure, I do have this in my investment portfolio, but I'm trying to use it the point. You have 8 days after the event here now, and now it finally looks like maybe it's safe to nibble in here. And nothing is ever safe. I mean, if it breaches those lows, you got to get out, but at least you have a reference point now. When you're just randomly buying Priceline, I mean, now you're down $50. I mean, where's your reference point? Where is your out? You got to, at all costs, in this market, when you're a trader, you have to protect your trading capital.
Okay, and I want to just make 2 quick points here before we move on. First, Priceline here. If you're a gap trader and you've been waiting since February 27th when it gapped off a report, you get down to 1635.32 because we're talking, a random level at 1635. That fills a gap from February. So that's an interesting level. It'll take a while to fill the gap, but there would give me a little inkling perhaps to try and cover short. And then Celgene, and I just want to mention the Celgene because they, just like the way Dennis is talking here, the institutions don't just hop in like that. And if an institution has not been in this stock, they want to target this stock, they're just not, the first day it happened to bottom at 94.55, but they're going to wait. I mean, if you have, millions of shares that you want to buy, you're just not going to, hop out on the first day. They'll work these orders over 2, 3, 4, 5 days. And that's why you have that kind of...
Bottom starts forming.
Exactly.
That's why a bottom starts forming. It's not because all the retail traders, love it. We love retail traders, but they're smaller traders. It's the institutions that really move the money. So somebody says, okay, I like Celgene at this price. Why not I can't just come in and buy 1 million shares at the market. The thing's going to pop 5 points. So I got to work it. And that's why a bottom forms. It's because, the institutional money is coming in here and just slowly buying. And that's providing support to the stock, which we then see in the chart. And, and that's just, the point that I've always been trying to make here too is, technicals are great. It's a great way to get a picture, of what's going on. And, I use charts as well. But the one thing I use more than charts is order flow. And I believe the order flow, I know the order flow is what makes the charts happen. So when you become a good order flow trader, you can predict the charts a lot more accurately. I mean, you can say, oh, there's a pattern or there's this or there's momentum or, from the chart. But order flow is what makes up the charts. And, look at the chart of Ford.
I knew you were going to go to that.
Say,
yep.
Yeah, and you can say, oh, well, 1250. It's easy to see resistance here now a month later. We were saying resistance at 1250 on October, the first day it was up there. Why? Because it was over 1 million shares to sell at 1250. Well, it takes over $12 million to take out that order. Nobody came in. It needed an institutional buyer to take that out. It never got it. So if you were just looking at the book, it's $60 a month. You can buy the open book. It helps. Like people think, oh, it's useless information. Well, I'll tell you, I can prove that wrong because my P&L will tell you it's not useless information. I make a lot of money off the open book. And when you see 1 million shares out there sitting at 1250, it's going to act like a blocker. And it's going to, block the stock from going higher until somebody has, the money to take that out. Ford never found a $12.5 million buyer at 1250, and that's why it failed there. It's not because the chart was looking bad. It's not because of any reason. The only reason is that huge seller was there. That is why you see all this resistance at 1250. It got to 1246 back in October, 1247, 1248, 1247, and it gets a little bit ahead of it because you got other people, opportunistic traders like myself, stepping ahead of that 1247, 1248, 1249, because we know it's going to take a lot of money to take it out at 1250. So what I'm saying is this order flow predicts the technicals. Order flow actually makes the technicals happen. So when you can become good at reading order flow and reading the tape, you can become a lot more, predictive than just looking at a chart.
Okay, Samir has a question, and I think, you pretty well answered it. But if you just want to, the only thing I want to add, the time in sales is good after to see if the size actual traded. What Dennis is talking about is the open book on the New York Stock Exchange where you could see the actual resting orders. So, Dennis, you want to add anything on that?
Yeah, and I mean, I use all that. I would consider all that in, order flow. If you're an order flow trader, and that's what I am, if I had to define myself, what am I? Am I a technical trader? No, I talk technicals a lot on the show because, picture's worth 1,000 words. We're doing a radio show. It's easy to show a picture, and it's easy to get a good, it kind of summarizes what's happened in the stock for you. So it gives you that background knowledge that you probably need going forward. But I wouldn't say I make a lot of trades just based on what the chart looks like. I make a lot of trades based on what I'm seeing in order flow. And that is made up of a lot of different components. The one component, that is more predictive is looking at the open books. And you can subscribe to these books. Somebody was just asking me, how do you get the NYSE open book? Well, yeah, talk to your broker. Make sure they first provide that information. Most of your brokers, I believe, should provide the information. And then $60 a month, that charge goes to the NYSE. So that's what they charge for it. So, I can get it on multiple platforms, but, I know Interactive Brokers has it. There's probably a lot of brokers that do sell that information. That's one thing that I use. It's not, as valuable because a lot of the orders you see out there, and this is why a lot of people say don't use the open book anymore, because there's a lot of orders that are high frequency orders that just move around. They're not real orders. But when you see 1 million shares sitting there, that's not a high frequency trading order. No high frequency trader is throwing out 1 million shares to sell 1250. That's a big institution trying to sell their stock. And that order will stand out like a sore thumb, and that can act like a roadblock for the stock to go higher. And then, there's ARCA book, all the different exchanges, you can subscribe to their books as well. I always like the NYSE book because I think a lot of institutions still use the original primary market. It's maybe out of habit, all these years. And I find myself that I do it. Why do you think, NYSE, gets bigger blocks? Or why do you think NYSE Because the closing process is still, manual. And I think, I have a lot of institutions, legacy traders that always traded that way and still trade that way. And I find myself defaulting to NYSE a lot too. I mean, I've got smart order routers and they'll take out wherever the liquidity is. When I'm placing orders out there, a lot of times I find myself placing them out there on the NYSE. And I think the NYSE has better fill rates than some of the other exchanges simply because there's other traders, legacy traders, institutional traders that always trade on the NYSE and just continue to do it.
Yeah, they'll do their orders there in other places. So 16 minutes into the show, let's get into...
Oh, this is interesting. A lot of questions spurred up here,
okay.
And we don't mind. Every once in a while, we need to do some just flat-out education. Instead of just talking, stocks here and talking, where we think they're going and doing calls and stuff. This is flat-out education right now. A lot of questions is popping up here from the chat here, too. And Joe C saying why would they show a big order like that? Why not do it iceberg? I don't know why. I completely agree with you. But if the institution's going to show their hand, why am I not going to use that information? I will tell you 90% of the institutions now don't show their hand. They do use iceberg orders. What an iceberg order is an order that is just showing the tip of the iceberg. So it'll sit there with 100 shares, and you'll buy the 100, and it won't move, and it won't move, and it won't move. And maybe that 100 shares is actually representing 10,000 shares or 20,000 shares, but they've just placed it as an iceberg. It's just sitting there as an order. It's only showing 100 shares, but there's really a lot more to go. Those orders is how I trade earnings events. So when I see, a stock that's really popping up, all of a sudden it's getting to a 100 share blocker and it's not moving. Those can be turning points because, again, there might be a lot of size there. Maybe there's an institution selling $5 million worth there at 100 shares at a time. Well, it's not going to take it all out because there's not the volume to get it through it. So that could be a turning point. So yeah, a lot of times when you see these earnings, pop up, and then all of a sudden they start turning the other way, a lot of times it's run into a big institutional seller with an iceberg order and just can't simply go through it. So, that's something you identify from the tape as well. Just looking at your time and quotes, looking at, the sales going by and saying, okay, well, it's hit it like 25 times. It ain't moving. And there might be a lot of stock here to go. Even Snap last night at 1270, I was looking at it last night. It was trading there for a long time, and Snap got killed. And we'll get to it in a second, break down the technicals. But there was an iceberg bid at 1270. They'd hit it for 5,000. 100 shares it was only showing. Hit it for 5,000, not moving. Hit it for another 10,000, not moving. I'm like, okay, well, there's a big fish here. That big fish can act like a roadblock to the stock going lower, and actually the stock turned around and started going higher after that point. So there's lots of different ways, to use order flow, and lots of different ways to do level two. And level two quotes is your depth of quotations, like looking what's behind, in the actual, quote book as well. But that's, so that's a lot, for Wednesday morning here.
No, that's right, Dennis. It's great education. The other thing I just want to say, as far as the institutions putting those orders out, I mean, because they might get done. If someone wanted to buy,
they're trying to get done.
They want to get done.
That's what they want. They want to get done.
And if you advertise something, like if someone really, let's say you're short, $250,000 Ford, and you're thinking, wow, I cannot miss that 1250 print. I know where I can get stock. They'll do it. And if there's some good news comes out Ford, which never has good news, where it has good news, it still goes down. But they know. And, with all the liquidity, all the different exchanges, I mean, Dennis, that's all we used to, we used to just be able to trade when the New York Stock Exchange volume, was 90% of the volume of the stock. I mean, those orders were there. They were real. You saw trip nines on something. You knew something big was going to happen. Now in a decimal-laden world, it's a little different. You got to do a little bit more homework. You got to be, watch out for the icebergs. I mean, there's a lot of.
It was just big orders everywhere back in the day, and the big orders would, move stock. It was always institutional money that moves stock. Anybody who tells you high frequency traders move stocks doesn't know what they're talking about. It's institutional money that moves stocks. High frequency traders are in there for the little spreads. They're in their market making. They're in there. They're not in there gaming stocks and driving them up and using hundreds of millions of dollars to drive this stock, down, 10%. That's institutional money that is moving stock. So high frequency traders are your liquidity providers. They're the guys in there, the market makers, the old locals, the guys making the spreads. They're making the markets. They get run over by institutions every once in a while. They got to look out for the big fish, because if you're a high frequency market maker and you're sitting there, buying stock, all of a sudden a big fish comes in to sell a few million shares, they got to get the hell out of the way or they get run over. And you know what that's all about, Joel, because you were a high frequency market maker, not like this, but you were a market maker on the floor and you were doing the same strategies that the high-frequency traders are doing today. You simply were just doing it in a little bit longer time scale because things weren't trading in milliseconds back then. They were actually normal, and they were, you could put orders together. It was a much different market, but it's the same strategies that you employed that high-frequency traders are employing as well. And you weren't moving price back then. You were making markets.
Yeah, and just the best example when we had Greg Bruno on the show, and we were talking about 2 days after the crash in '87, when that guy came in with a huge order for Shearson, and offered the SPOOs down 50 handles, which was 25%. I mean, that guy, I think he still had scratches on his body because people, just, flock to him to get a piece of the action. And, it's the same kind of thing. It's just in the decimal Latin world and, iceberg orders, things have changed a lot. But, Dennis, what you've been able to do is adopt your strategies and still employ, the same ideas. You just got to work a lot harder, to find them in the marketplace.
Employ them in different ways. So it's the same strategies that I was using probably 15 years ago when I first started. I'm just employing it in different ways, and the information is just different. So you got to read it. But once you see institutional orders out there now, they mean even more than they used to, because there isn't institutions that show their hands anymore. So, we're not, where everybody was showing their hand before, when you see somebody showing their hand, that is valuable information. You've got to know that, okay, well, there's a million shares to go on 1250 on Ford. That is going to act like a roadblock. So I'm not going to come here buy 1245, 1246, 1247. That's what the dumb money is doing. The smart money would wait until the 1250 is gone and buy 1251 or 1252. Maybe you can't anticipate, you think it's going to go, but when you're anticipating that it's going to go, sometimes it doesn't go. So, like that one day when they had news, it was actually trading above the 1250 in the pre-market, but that order was in the regular session. It wasn't available in the pre-market. So we knew when that liquidity came in, it needed to trade above that in the regular session as well, which is why we always take pre-market trading with a grain of salt, because a lot of institutions don't trade in the pre-market. Probably the majority don't, because the liquidity isn't there. So they're waiting till the real liquidity comes in when, all the players come in after 9:30. So just because the stock is trading through a level in the pre-market doesn't mean it's going to open that level in the regular session.
Yeah,
open above that level.
No wait. Let's say let's just go to Snap here and we'll do that report. Let's say they want to cover short at 13, right? Or they're not going to go on the way down. 13 bid for the float, right? They would have got peppered, but instead they let the thing go down to under $12, and they're like, okay, buy me 50,000 or 100,000 up to 13. That
slowly work it over the course of the next 20 minutes.
And let's just talk about this pop to 1609 on 10 cent. Spencer.
Okay, let's talk about Snap. We're first stock of the day. Here we are 23 minutes in the show. We're talking about our first stock of the day. It was a lot of education to start today. Hope you guys enjoyed it. SNAP, Spencer, we're bringing you back in here. Spencer,
did you fall asleep, Spencer?
First of all, give us.
Where's Spencer?
Spencer, are you there? Did Spencer take off on us, Spencer?
Oh, wait, what? What?
He went to get a bagel sandwich.
Yeah.
We're talking Snap, SNAP.
I was sleeping. Okay, great. I'm back.
Give us the report and then tell us what this Tencent purchase.
Okay, so Snap, this is an interesting report, and I'll get into my thoughts on this after I give you the number. Q3 adjusted EPS of a 14-cent loss versus a 15-cent loss estimate. So they beat the estimate there by a penny. Sales of about $208 million versus a $239 million estimate. So they missed that number as well. Average revenue per user coming in at $1.17, $1.30 was the forecast. Last number I have here is daily active users up 17% year over year, which is also lower than analysts were expecting. And I was actually pretty bullish on Snapchat heading into yesterday. I didn't realize, I obviously didn't know that they were going to get a big investment this morning. The news here is that they got 145 million shares of Class A shares bought via or by Tencent, and that is what has brought the stock back up this morning after yesterday's disappointing report. My thoughts heading into this report and why I'm a little bit confused this morning is I've seen multiple surveys. Piper Jaffray does their annual technology survey. Seen a couple other surveys as well that say that Snapchat is the most popular social network among teenagers. And this is not millennials. This is the people younger than millennials. These are, I guess, Gen Z is what they're called. And I've seen multiple surveys that every year, 2 years in a row now, that Snapchat is the most popular among Twitter, Facebook, and Instagram and Snapchat. Snapchat is number one among teenagers, and so
do you still Snapchat?
Yes, and so I was feeling good about the stock heading into this report because for a year and a half, I've been seeing these headlines that Snapchat is the most popular among this demographic, and that's the demographic that you want, right? You want the young teenagers. So either those surveys are meaningless, or this is an overreaction from Wall Street, one way or the other.
So you're telling me you like it down here at 1334?
I'm not running for the hills, no.
I don't like it at all. And this is just a valuation issue for me here. I think, you got Instagram eating their lunch. I think there's a lot of, other companies that could potentially eat their lunch in the future. I don't Snapchat, so maybe if I did, maybe I would like it better. Maybe I'd have, a connection with it. I don't have any connection with it, so I'll just say what I think. I think this company is not growing nearly as much as everybody thought it was going to. I don't know if this company is ever going to be profitable. The valuation scares the hell out of me. I mean, yesterday it was trading at like $18 billion valuation here, which seems absolutely asinine to me for somebody that just has a messaging service that disappears when you message it. a dancing hot dog. I mean, this all sounds absolutely ridiculous to me. So as an investor, I'm completely out. I'll go with the what's his name? The guy on the show all the time. Anyways, I'm out.
Kevin O'Leary.
Yeah, Kevin O'Leary or Mark Cuban or any of them. I'm out. No, I was trying to think of the name of the show. What's the name of the show?
Shark Tank.
So it's early in the morning.
And to that, I would say,
I'm out.
To that, I would say, yeah, they're definitely not growing as fast as people thought. That's obviously not a good thing. But at least they're growing a little bit. Twitter isn't growing at all. So at least they're growing.
And the teens that all use this now, they're all cheap. And if you actually had to pay for this service, they'd all be gone. If you actually, were a different way. It's hard to make money from all the teens nowadays. They're so savvy. They're smarter. They find things for free. So you can never, ever charge for something like this. So that is off, Like with Twitter, I've always said it's a little bit different. And if you compare Snap and Twitter, they're basically the same valuation. I like Twitter a lot better than Snap. And maybe, it's because I have a Twitter account. I do some tweeting. But there's easier ways to advertise, I believe, on Twitter. You're looking at tweets. You're looking to read something. It's in your face. Even though it's annoying, people are actually reading stuff there. In Snap, they're just reading their friends' messages.
Okay, well,
so it's trickier to really conquer advertising on a medium like that, is it not?
Well, to that, I would say Facebook is free also. The trick to revenue has never been...
Facebook is smart. I mean, Facebook has all the advertisements kicking around and looking at you. I don't know. Maybe you're right. But.
The trick has never been to get your users to pay for it. That's never been the right answer. The right answer is always get brands to pay to post or to advertise.
And I'm not I'm just saying that I think Twitter has that in their back pocket, because I really do believe if if Twitter started charging $1 a month or $5 a month for the service, I don't think everybody would leave it. I think they would lose some, but I think a lot of people would actually pony up and pay it. And maybe they'd lose half, but there'd be a huge amount of revenue there. I would pay $5 a month for Twitter.
You would pay $5 a month. Oh my God.
I would pay for Twitter because I get information from it. Maybe it's too high, but maybe even like $1 a month, just something. Maybe you lose half. I think if you charged $1 a month for Snap, I think 99% of the people leave. So all I'm saying is I think the user base in Twitter. I'm not saying they should do this. I'm just saying the user base in Twitter is more sticky than the user base in Snap. The users in Twitter are stuck to the service. It's not that. What competes with Twitter? Snap is a message service. What actually competes and has the same type of product as Twitter? What really? I'm asking. Is there something?
I would say maybe Google News. But so would you pay? So I'm assuming that you pay anywhere from $8 to $10 a month for Netflix. So you would pay more for Netflix than you would for Twitter.
He didn't say that.
Yeah, I would want to pay more for Netflix because you're getting movies, you're getting an actual service. I mean, Netflix is the whole reason why I'm bearish every cable company out there.
Fine.
And and that's a whole nother. Why am I going to pay $60 or $70 a month if I'm a teen? And I have a cable. I still subscribe, but I don't see. And we've obviously gone on a tangent here as well. But
I'm sorry, I dragged this off.
I think it's Netflix is eating the cable company's lunch. I don't see, if we're just comparing, I think all I'm saying is I think the Twitter user base is more loyal to Twitter than the Snap user base is loyal to Snap. So if I'm looking at these two stocks and comparing them just from a valuation perspective, and let's get the actual market caps of the two companies here. Just comparing Snap to Twitter. They're nothing to do with each other, but they're both, social media platforms here. And Snap's, market cap as of yesterday was $18 billion. Twitter's market cap as of yesterday, and I don't own either of these stocks. I think they're both overvalued. Twitter is 14. I think if you put on this trade, and you got to obviously consider, a lot of factors, and the one factor being, cost to borrow stocks. But I think, I like this as a pairs trade. Long Twitter, short Snap. I think you win. I think if you look at this a year from now or 2 years from now, I think Twitter's market cap is above that of Snap's. That's my call.
All right, let's go to the trading action here in Snap. And Dennis, I thought you might get out of the journal there for selling the all-time low.
I was hoping.
I know.
I did.
I know. 1178.
I've still sold the all-time low.
Yeah, let me just show you all.
There's a DDD right attached to that little low bar. You can just write D. I sold the low in Snap.
I wish
Nobody ever says that, but I do. I'll tell you, I sold the low in Snap. It was me.
I wish I had Nick Shaheen with me because he could write Dennis sold here. But
on his chart, like instantly, because he's so quick at making those charts.
And with multiple time frames on them. Well, 1178 doesn't look like you're going to see that. You're surely not going to see 1609. Just settling in here. Price discovery going on. Looks like you're finding a buyer in the lower $13 handle. Let's go to the dailies to see if we can get any confirmation of that. Yep, there you go. Couple lows at 13 in September and a couple more in August. So it's still a little bit of ways from there, but I like the $13 area ahead of that pre-market low of 11.78.
We already gave you my thoughts on Snap, so we'll move on to the next stock here that's on the list. And there's not a ton of big companies, but there was some interesting ones. Take-Two, TTWO. I'm getting dyslexic here, Joel. I'm getting that from you. TTWO trading up 14 points in the pre-market. This was a blowaway quarter. They blew the numbers away on the top, the bottom, the guidance, everything. Spencer, details.
Take-Two and ZYNGA both reporting yesterday. Take-Two reporting a Q3 EPS of a 3-cent loss, but that does not compare to the estimate. They had some tax stuff or financial stuff. Sales of $443 million versus a $510 million estimate. So they missed on the sales number, but their fiscal year EPS is coming in. Actually, is that right? Am I reading that correctly? Fiscal year sales coming in $1.74 to $1.84. I'm sorry. Let me read that again. Sales $1.74 to $1.84 billion is what they see for the fiscal year, is in line with the estimate. The fiscal year EPS coming in at 55 to 80 cents. That definitely does not compare to the estimate. So there's some financial.
I saw some other numbers. You had to just take out the adjustments and stuff. And I was looking. They beat on the top. They beat on the bottom. They beat on the guidance. That's all you need to know. That formula equals higher stock price. And the stock not only taking out the highs of the move, blowing them away. We're now 9 points above the high from 4 days ago. 247,000 shares already traded in the pre-market on $120 stock. Traded a ton of volume last night as well. They actually halted this. It reopened in the 114 or 115 area, and the stock is just a monster. I mean, TTWO, the gamers, whoever it is keeps driving this. This stock is one of the best performers in the last 5 years. This is a $7 stock in 2012. It's now 120. You're talking about a stock. I can't even do the math on that, Joel. What is that, up like 700% or something? Crazy. It's been an unbelievable performer.
Tough one here to call. What I would do if I was trading this or long in my account, I would look for that follow through the pre-market high. And right now that stands at 120.50. Let's say we open up in the 119 handle. You got to take that out in that first 5, 10, 15-minute bracket. See if buyers are still there to take it out, to other levels. If not, you could back and fill. Also, I've seen, and we've seen this once, we've seen it 10 times, 1,000 times. You might not even see that 120.50 today, so that's my level right now, but keep an eye on it right before that 9:30 bell. All right, Spencer, 8:35, 32 seconds. Who's our guest?
Our guest today, Morad Askar, otherwise known as Futures Trader 71. That's his handle on Twitter. That's also his website. And we'll be right back with Futures Trader 71.
Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel L. Connon, along with the fired-up Dennis Dick and Spencer Israel working the boards. And we are joined by Morad Askar, better known as Futures Trader 71 in the Twitter sphere. Morad, how you doing today?
Good. Thanks for having me on.
Yeah. So I know you were in the chat earlier, and on our show, we like to talk about individual stocks and futures as well, but we also kind of like to talk about education, things that we've learned over our years in the markets. I know you did stocks for a while. You made the transition to futures. Talk to us about that transition. And then we were talking about the order books and order flow, and you see a lot of liquidity in those S&Ps, but sometimes it's fleeting. Tell us how you work it.
The transition was right after 9/11. Stock trading in the style that I was doing it in was drying up. So I moved up here to Chicago from Boca. I was working for Schoenfeld, and just moved into futures. And I never went back to stocks simply because the advantages that futures might have, including tax advantages, the 24/7 kind of market. And I didn't have to do as much digging around when it came to futures. It was everybody was trading the same product on the same exchange, and also costs were a lot lower. So I never really went back to trading stocks other than, just investing here and there. I think that was the first part of your question. I forgot the rest. I think the other one was the order flow. Is that correct?
Yeah. Order flow. We talked about the New York Stock Exchange open book. I know there's times where SPOOS has a lot of liquidity. Sometimes it doesn't have as much liquidity. Just talk about how you trade, the S&Ps, whether or not you use the book.
I do. I'm a heavy, even when we traded equities, it was on a level 2 screen, and the order flow was a key factor. We actually had charts that we never even looked at. We would trade across 10 stocks or so, and it was purely order flow based, almost acting like a market maker. And when I switched to futures, and especially in the S&P, that skill set was really what I carried over. Except that trading in that method in this market with the speed of co-located computers and so on, it's hard to compete at that level. So I had to expand my time frame back in 2005 and onwards. So I look at the volume profiles, and then to come up with context, volume profiles, internals, to look at the context of what the market's trying to do. But when I engage with the market, in other words, when I'm about to click, I use what's called a heat map product called the S5 Book Map. You can get it at s5bookmap.com. It shows you the heat map and how the order book is changing over time, but also gives you the order flow, how much is being filled, and it gives different size dots for the fill sizes. If they're red, they're hitting the bid. If they're green, they're lifting the offer. It gives a pie chart as to how much of which side is being traded at a certain price. And to me, once I set the idea, the trade idea, and the context, it's really all about order flow and leaning against the size in the book in the direction that I want to trade in order to engage with the market. And I do that simply to I call it, finding. I'm always looking for something to lean against. Mm-hmm. To manage my risk. I don't want to lean against something that looks fake, that's been in and out of the book, and then I get in, they pull, they lift, and then next thing you know, you have a stop run if I'm short to the upside, things like that. So order flow is a key element. Things have changed quite a bit. I mean, the S&P, regrettably, the S&P has been, in my opinion, a dull trade for the last year and a half or so. It's become a buy and hold stock. Mm-hmm. In general, I'm looking to sell pops into new highs on resistance. Like yesterday, my plan was sell everything from 93.50, 93.5 to 25.93.5 to 25.95. And then buy back anything around 25.80, and the high was 93.5. Yeah, I couldn't get on that. It turned at 93.5 too quick. I couldn't get on that. I had to wait for a pullback down at 25.89. But I'm not talking out of a backwards. I'm not looking back 2020. You can actually catch the pre-market broadcast where I outlined that plan before it happened on youtube.com/FuturesTrader71. You can see how I'm coming up with the plan. And the low was 25.80.75 against 25.80, which is a pretty decent short-term support level. The more interesting trade, in my opinion, has been small caps, and I do that in the Russell. The Russell on the CME has pretty much failed to hold any pop higher. And yesterday it dropped 15 handles or so, which is pretty good range in that product. I think the ETF is RUT. For those who only have the equity feed, I find that there's a lot of weakness. I see a lot of weakness in the smaller caps, and every time they try to pop with the NASDAQ and the S&P, and I'm monitoring all indices, including the European ones, I find that the Russell tends to fight the tape going up and then easily drops, and it's been in this downward sloping channel, almost like a flag pattern that I've been trading against on the short side.
We're on the line with Morad Askar of FuturesTrader71.com. Morad, I just want to go back. You mentioned the term leaning on, and Dennis and I were talking about the open book on the New York Stock Exchange. Just walk us leaning and then pulling, and then how you react to it, and how do you tell which ones are the fake orders?
So it used to be, to gain that skill used to take, like for my prop traders, I mean, all we did was trade the order book. It used to take about 6 months of watching the markets every tick, every day from start to finish to actually gain the skill set to kind of be able to see almost on a subconscious basis what the market is doing. It's a lot like a baseball player hitting a fastball. How do you know where to swing? It's not something that you think about. It's something that happens subconsciously at very, very high speed. But now, everything is so obscured by these flash quote machines, a lot of spoofers in there. The exchanges do their best to eliminate those, but you can't lean on anything without history. And that's why I lean on technology in order to do that. And so I use a heat map that shows me how the order book's changing over time. And those orders that are actually, a trade desk that is trying to fill, those orders stay steady in the book, and it shows you where those are. And I'm not going to find, like, if I'm looking to get short the Russell, I'm not going to find a big offer and just stand in front of the offer, put my limit order short to sell in front of it and just sit there and wait. I'm looking at how is the market responding to that size. So, as we move up, is the market lifting and lifting and lifting strong and causing price to auction higher, or is it lifting and lifting and lifting strong, but it's not going anywhere? Because there's an iceberg, there's somebody who's selling into that strength, like we often see in the Russell. I see that, it's a thin product, but I see it more clearly because it just moves up. It's whack-a-mole, it moves up and it just gets whacked and gets whacked and gets whacked. And then size starts coming in because people start to realize, or other participants start to realize that, hey, this thing's not going to make it. Let me offer out for a scratch. And then you see this stable, steady offer out there. And that's what I'm leaning against. I'm ready to get out. I'm ready to close the position if it blows through. I'm going to get caught with everybody else, but I'm not one that's going to load the order book with my orders and just sit there. I have to see how size responds as the market moves to it. If size increases as the market moves into it, that is most likely going to be, it's not always, but it's most likely going to be meaningful size that's coming in to get filled efficiently at one price if possible. So that's what leaning against is. It's not about looking, and I see a lot of people just putting their orders out and then using these small stops, and then all they're doing is just giving their money away because they just put these orders out at the support and resistance. The market runs through, and then it holds for a second, and then it continues. They get stopped. I have to see, I'm much more of an active trader in that I have to see how the market's responding in the moment.
All right, let's just talk about yesterday too. And I know you're trading during the regular sessions. You picked up that 93.50 level. I was discussing it with the Brentster on the desk. That was the pre-market high. Didn't really have anything on the weeklies there. Was the 93.50? Was that your number because it was the pre-market high and you were looking for either to fade it or follow through from it, or did you have something else in your secret sauce that gave you that number?
It's a great question. It is the pre-market high. I didn't have anything out there. It's a new all-time high in the S&P. We've never traded up here, so I don't have any reference in this area.
Excellent.
However, what I'm looking for is the context and the way that high was made. If you look at the pre-market chart, the way the high was made on the volume profile, as the price started to move from 90 into 91 and 92 and 93.50, you had much like a parabolically less participation, parabolically less volume going off into that price. And that shows an extreme, an unfair, what we call an unfair high. In other words, as price auctions up, here's the iPhone 10, right? It's priced at $999 at the store if you want to stand in line, correct? Right. Now, if I go out there and I say, hey, you can step out of the line and get one right now for $1,100, I might catch, 10 or 15 people who are willing to pay the $101 to skip the line. But if I say, I can sell you this iPhone for $1,600, I might catch one person who's about to jump on a flight and has to have it, and they'll pay up. But as price goes up, the participation or the volume executing gets smaller, it's lower and lower because the price is becoming more and more unfair. And then the market return pushed all the way down after it put in that high early in the session. and it traded near lows. And then the next time it came up, I'm expecting, even if it pushes through that 93.50, that it's likely not going to go through by far. So I'm able to fade or trade against that price with a tight stop for a quick return, looking for 2 to 3 points on that trade. You see, I know that's a long explanation. It's better done with a chart, but
it's an excellent.
You have to look at how the level's being made.
Yeah, and I just pulled that up, and I did see the volume there. And when the big boys got a chance to do it in the regular session, they went all out there, and you could see the volume kicking in. 2 quick things, and then we'll let you go here. One. How much attention do you pay to the stocks, Morad? I mean, you're trading the S&P futures, you traded the small caps. I think during our discussion, the top 10 stocks in the S&P make up 22% of the index. What do you do? What do you keep your eye on besides the order book and your technical levels?
So because I trade indices, like you explained very well here, the underlying are the stocks in the index. I cannot monitor 500 stocks or 2,000 small cap stocks or 100 NASDAQ stocks. So what I do is I have a cash index chart that updates every 15 seconds, and it's got the ETFs that represent approximately 70% of the S&P, and those are the financials, which is XLF, technologies, XLK, industrials, XLI, healthcare, XLV, and the consumer discretionaries, XLY. And I basically create my own index, so to speak, of how the underlying is moving. So that gives me an idea of what sector is dominating the movement with the S&P. What are we fading? In addition to that, I have a FANG chart that has your Netflix and Googles and Apples and Amazons and Facebook, just to see that's more heavily weighted towards the NASDAQ, just to see what's dominating there as well. And if I see that one is really dominating, like Apple's just taken off today or something, I'll pull up an Apple chart and just stick it in the corner. But I also use internals. So I'm looking at advanced decliners on the New York Stock Exchange, the volume up versus volume down, the ratio of those. I'm looking at the tick. Those don't create trades for me, but those give me an idea of what the overall aggression is in the market. Is this trend for real? Is it supported, or is it floating up on very little participation in the markets, mainly sideways, which means I should not overstay a long that looks like a trend day, but the underlying is not supporting it. It keeps me out of trouble than it gives me signal. Yeah, it's not a signal, but it does keep me out of trouble.
All right. I know you do your video around 9 o'clock. I don't know if you need to prepare for that. I just want to see, we've had a nice range in the S&P overnight. I was just wondering if you could give us a sneak preview of a setup for today.
So this morning, yesterday after making that 93.50 high, we went and tested below Monday's low. So we got above Monday's high, tested below Monday's low, and then we pulled back and closed right in the middle of Monday's range. This is balance. This is officially balanced, right? So what this is, if the S&P continues on the path that it's been on for a long time now, what this is we're likely to get a rest day today. We're likely to trade a smaller range. We're likely to test that 25.80.75 at some point or thereabouts. But generally today we're likely to accumulate the energy needed for the next leg up. And the next target I have up is 25.9650 is the next measured move higher. That's just a projection of the prior swing. I look at the market movement as energy. I'm an engineer. I was an engineer by trade, so I look at things as energy. How much energy do you need to accumulate for the extension that you're going to get next? And I use fib extensions for that when I have no reference. But overall, I'm not looking for any excitement. There's very little on the economic calendar today. I'm not looking for anything to happen. Now, I'm saying all that, but knowing that President Trump is in Asia, and who knows what's going to be said, and you got to take news into account, and that's where your news service and so on comes into play. But overall, not expecting too much of a range today. Probably 7 to 8 points tops in the S&P, and a test to the downside early.
Morad, as much as Dennis loves talking about education and the order book, he knows I love talking about futures. You're one of the best guests we have to do that. Morad Askar, futuresbig71.com. What a pleasure. We're going to get you on again real soon. Thanks a lot, Morad.
Thanks so much. Take care.
All right. S&P futures battling their way back. 85 and a quarter is your last print. We're keeping an eye on that pre-market high of 87.50. It turned out to be a good level yesterday. Dennis, man, we've been talking a lot today and not much about individual stocks. Do you want to cover a couple of big
I'm gonna go off the charts, and I'm gonna go to Colgate CL. Just breaking here right now. It looks like there is some chatter here. And this is what's just been coming across here. It's takeover speculation. That's why the stock is popping right now. 3 points here in the pre-market. Not sure where that information is coming from, but just had to come across my terminal, and other information source here or there, that CL is looking at possible takeover speculation. We saw this a while back in Colgate. Do you remember, like a couple years ago? Yeah, there's been rumors before in Colgate. Nothing has ever materialized, but there's rumors surfacing here again this morning, and that's why the big pop up here in CL this morning. It's only up a couple bucks. Again, just rumors here. I don't even know if they have an acquirer there, but there's definitely some speculation here this morning that Colgate is back in play.
All right, 74.52. That was your high print. Now pulling back at 73. You want to see confirmation of this if you want to be, piling into this stock. We came very hard off the $76 level. When we were doing that, when we were careening down, we had a 74.85 high. So right there, 74.52 high, 74.85, 75. That's my bogey on the upside without knowing who's coming in or the speculation. But with these kind of things, if there's a rumor, you want confirmation, and see what's happening. This has happened a couple times in Colgate. A very an underperformer. Maybe not. The stock's not doing too bad in the relative market. 858. Dennis, let's just talk Twix and AT&T. It looks like we may have a little bit more delay in this deal.
Yeah, they're saying that the timing of the deal is uncertain here now, and that's why TWX is getting whacked in the pre-market once again. I mean, this was 102, and everybody thought, this deal looks like it's going to go through, and boom. And now, obviously, it has hit the – it doesn't look like it's a sure thing as maybe the market thought it was, and stock now down 92.60. We did get down to 92.02 when there was rumors first surfacing that this deal could be, in trouble. And now we're coming and retesting that level here again. One concern for me, and we analyzed this a few days ago, and stock was around $95. It's just the risk-free return here when I look at TWX, because the media companies have been in shambles. And I think TWX, when it got taken, when this news came out, stock's around $85. So you could say logically, worst case scenario, stock doesn't get taken over, goes back to 85. Best case scenario, it goes up to 108. So it looks like a good risk-reward. What you're not considering if you're doing that, though, is the fact that media companies have been killed since then. So I think, without, AT&T taking over Time Warner, I think Time Warner is not an $85 stock. It wouldn't be surprised me if it's a $75 stock. When I look at that risk-reward ratio, it doesn't look nearly as attractive here. But, this deal is still not dead. They're just saying, the timing of it is not known here now. But there's more uncertainty here around the deal, and that's why risk arbs are putting a discount on TWX.
I would add this. I would still, and I said this Monday or Friday, I would still be stunned if this deal didn't go through. But if, for whatever reason, it does not go through in its current state, I would not be shocked then if Time Warner were to sell off as casually as it can CNN and other potentially toxic assets as they relate to the deal. So that would not surprise me. If this deal gets blocked in its current form, wouldn't shock me if Time Warner then said, all right, well, what would you do if we sold and got rid of CNN and maybe some assets that the administration doesn't love so much? Then would you do it? So that's all hypothetical, all speculation, but that's all.
That's what it's all about. All right.
That's all I'll say.
Dennis, 9 o'clock here. You just want to...
Without Colgate rumors coming from Alphaville. That's where it's coming from. which is different than Betaville? Or is there one Betaville and there's one Alphaville?
Listen, Alphaville is Financial Times. Betaville is not. I made that mistake yesterday.
Okay, so Alphaville is Financial Times, and that is a more legitimate source.
What about Gamaville? Is that...
What about Joelville or Spencerville or Triple Dville?
All right.
Anyways, that's your source. It looks like Financial Times Alphaville is where that rumor is coming from. That's why the stock's up 4%.
We get some quick and balances before we go, Dennis?
Yeah, sure. Square 67,000 to buy. Does report earnings after the bell tonight. Cautious going into that report. I've been long Square in and out of it from the long side for a long time, but has run up significantly into the report. So it absolutely, for it to go higher, needs to blow it away. Not saying they can't do that, just saying, there's a lot of scenarios on the table where this could actually go down after earnings. So if they blow it away, it goes higher. If they beat, it's probably not going to be good enough. If they obviously miss or come in line, it's going down. So I say 3 out of 4 scenarios, it goes down. The one scenario is they got to blow it away for it to go higher. So I'll probably be flat going into the earnings tonight.
All right. Go ahead, Spencer.
Just Square?
Square, no, GE, 161,000 to buy. See, the GE trend continues. It's 3 days in a row buy imbalances here, and it's up here again. So GE, tight range yesterday, 13-cent range. When was the last time you always saw a 13-cent range there in GE? Anyways, I feel like the tide still turned here a little bit for GE. So I'm a little bit bullish just from a trading perspective. Long term, who knows still. Twitter, 23,000 to sell, but that could end up going to buy. It's trading up because they're going to 280 characters, which I don't like at all. And I think we were talking in the pre-market show that you are not a fan of that either, Spencer, but it is what it is. Looks like we all got more characters there now, and not a fan of that. Alibaba small buy and balance stocks trading down significantly though, so that could flip. Procter Gamble 42,000 to sell. Just watch some of your consumer products. This Colgate does have legs. Sometimes some of your other consumer products could catch a sympathy bid.
All right, we covered a heck of a lot today. I have to say this was probably one of our best shows of the year. I loved the chat today. The chat was on fire all day today. Also, some people in our YouTube comment section as well on Benzinga's YouTube channel. So thanks, everyone, for all your participation today. Thank you again to Morad Askar, who joined us, our Futures Trader 71. If you want to catch our show again, you can do so on our podcast, which is on iTunes, SoundCloud, and Stitcher. You can find it by searching for Benzinga or PreMarket Prep on any of those platforms, or you can just rewatch the show live on Benzinga's YouTube channel. It's youtube.com/Benzinga TV. So that's it for us today, folks. Hope everyone has had a good morning so far, and hope you have a good rest of your day. We'll be back with you on Thursday.